Hi class, and welcome to this video which is going to cover two key knowledge points from Unit 3, Outcome 3, which is all about how Australia interacts with the world economy. Today in this video we are going to focus on the historical causes for Australia's current account deficit and look at the relationship between the current account and the capital and financial account. So if you're a little bit unsure what these terms mean, you might want to look at a previous video on balance of payments. The first key knowledge point is we're going to focus on what are the causes of Australia's historical current account deficit, even though we're actually in a surplus at the moment, and think about what are cyclical and structural factors that have influenced this historical deficit. So before we go through this, let's recognize what is the current account and the balance of payments. We're thinking about in the current account all the inflows into Australia and outflows from Australia to overseas that are one-off in nature. So there's no ongoing financial obligation. And if we think about this, up until, because the big blue line is the current account, up until roughly April 2019, we have historically been below the line of zero, so we have been in a deficit. So this represents the historical current account deficit, meaning that we have been having more debits or outflows from Australia to foreign countries than inflows of money coming into Australia from foreign countries historically. Now, of course, you can see from 2019 onwards, we've been in a current account surplus. Why have we historically had a big current account deficit? You can see that there is one line in particular that has driven this, which is historically always been a deficit. And this is our net primary and secondary income, which is all about recognizing the payment of income of assets. So we have been paying money from internally from Australia to overseas because foreign entities have owned a lot of Australian assets. This has become partially and now fully offset by this line, which is our balance on merchandise trade. This is the fact that we are now exporting more goods than importing, particularly since 2016. You can see here, ever since there, we have had a mining boom, and therefore our exports of goods is greater than our imports. And by the time we got to the point of 2019, that more than offset our net primary income deficit. Having said that, you have seen historically, there has been a current account deficit, which means there has been more outflows than inflows. And historically, that's had to be something that Australia has had to deal with and have to finance from their capital and financial accounts. And there is two primary causes for this deficit. We're going to split them up into structural causes and cyclical causes. Now, structural causes are ones that I would consider to be permanent economic conditions. Now, if they're permanent, sometimes you just have to recognize these and there's not much you can do about it. The structural causes that lead to more money going out of our country than into our country is that Australia is a relatively young and small country, and to maximize growth, they've continued to require investment from overseas because we haven't been able to fund this investment sufficiently in Australia. So to continue to grow, because Australia is so small, we've had to look for overseas for our investment. Now, this is known as a savings investment imbalance, and this means that Australia has had to borrow foreign funds in the form of debt or equity that's recorded in the current account. over the time, this debt must be repaid through interest payments and equity in the form of dividends, and these are recorded in the net primary income account. So while the initial investment has been occurring in our capital and financial account, all these payments of debt and interest and dividends have been flowing from Australia overseas because of this foreign investment. Furthermore, the global competitiveness of us compared to our other economies is quite low. And this is because we actually have a high cost structure, we have high labour costs, and we're actually not, unfortunately, that efficient. That combines with the fact that we are relying largely on mining exports, which go up and down their price quite a lot and which we can't control, has meant to when the mining booms are not occurring or prices are low, we often have structural, permanent reasons for us to have our deficit. So, small country requiring investment from overseas to continue to grow has led money flowing out of our business, out of our country due to dividends and repayment of debt. Now that's permanent and one that we just have to deal with. Cyclical causes are a result of changes in the business cycle when there are significant changes in the level of aggregate demand and growth. So these are cyclical because of the business cycle. Hopefully these are things that we can deal with. What are some of the cyclical reasons? When the growth is stronger, there has become a gap between our saving and our investment. Because when growth is strong, we're less likely to save. When there has been this investment, we have looked for borrowings from overseas to drive that investment, and this has increased the size of our current account because then we have to pay that off afterwards, and this comes from our net primary income debits. So it's important to understand both of these, and it's important that we recognize that there are structural and cyclical reasons for why we have a deficit, largely stemming from we need to get our investment from overseas. There is a relationship, as you might understand, if you look at our cyclical one, between our current account and our gross domestic product. This chart tracks the movement between Australia's gross domestic product and the size of the current account's balance. As our growth slowed, we started to see more of a surplus because we were less likely to ask for more investment, and you'll probably start to see some relationships there. Not always perfect, but you can see our current account went into, it's a little bit inconsistent. What is more of a cyclical movement in our current account deficit is the relationship between spending or gross national expenditure and our current account deficit. When spending is strong, and if you notice that our spending was really strong in 2011 and 2012, our current account deficit increased, because we remember if it's going down, we're going to into deficit. Now, what you might want to do is start to think about some of these debits and credits and try to think, are they structural or permanent or as a result of our business cycle? And I'll get you to do that in your own time. What I do want us to understand is that there is a relationship between our current account and our capital and financial account. And the most important relationship is that the balance of our current account, whether it's a deficit or surplus, must be offset by our capital and financial account. So the balance of our capital account, whether it's a surplus or a deficit, and we're in surplus in 30th of June 2020, must be offset by our capital and financial account because we must always balance our payments. So because we had a surplus in our current account it enabled us to have a deficit in our capital and financial account, which was as a result, which meant that we balanced, which meant that in terms of capital and financial, we were able to have money leave Australia. And that $35 billion was largely driven by outflows in other investment and portfolio investment, although we were then happy for our money to be coming into our business, into our country due to net direct investment. So what does that mean? Australians or the government took the opportunity because of that surplus to invest also overseas. Now that hasn't been a typical thing. Often we know we have a deficit. And for example, in December quarter of 2018, our current account deficit was $6.7 billion. This effectively meant that Australia spent $6.7 billion more than it earned as a nation. In other words, national spending exceeded national income or exceeded gross domestic product. Because Australia spent more on imports and servicing foreign liabilities such as interest on its foreign debt than it received from its exports and earnings from foreign assets, this shortfall had to be financed by the capital and financial account and was largely financed via debt in the financial account, leading to a balance of payments. This has been something that historically is what occurred, but of course now we are in a surplus and the reverse has occurred and the current account is in a surplus. And as a consequence, Australia has now earned more than it spent over this period as GDP experienced gross national expenditure. This means we're able to generate income from foreign sources and we're actually able to look at doing some foreign investment. Now it's quite complicated this and it does take a bit to get your head around and sometimes a little bit hard by watching video. I encourage you to read your book or your textbook or your slides, however you're using it to build your understanding. But I hope that this gives you a good understanding of why Australia has historically been had a current account deficit, including the cyclical and structural factors, and what is this relationship between the current account and the capital and financial.